Good morning.
Good morning, guys.
Hello, everyone.
Happy 2024.
Happy
Yes.
New Year.
Happy New Year.
So, is Marco with us as well? He's on mute for the moment, but let's jump straight into it. It's a big year, we hope.
Yep.
In the crypto world, there are a few topical topics for the year. One is the Bitcoin halving, and one is the ETF. Certainly, all over the mainstream media, we're starting to see a lot of action and activity. Will the SEC approve these ETFs or not? We'll wait and see. But let's dig into some of these topics in a little bit of detail. I'm going to bring up a few slides as usual, just to run through during the call. And we'll start with the Bitcoin halving. So, well, what is the Bitcoin halving? For those that aren't aware, in the code of the Bitcoin blockchain, aside from the 21 million scarcity we all know about, there's a programmed halving mechanism. Miners that are there to secure the network are rewarded for that activity, and they're rewarded with Bitcoin. Every 10 minutes, as a new block is added to the Bitcoin, they receive their reward. When the blockchain first kicked off back in 2009, each miner received 50 BTC. 4 years later, that was cut to 25 BTC. Approximately every 210,000 blocks, if I'm not mistaken, which corresponds to roughly 4 years, that reward halves. It went to 12.5, then 6.25. This year, it halves again to 3.125. What does that mean? That means that all of the mining activity yields a lower reward, and therefore all the competition in the mining space will yield a smaller gain, a smaller benefit. That has a few repercussions. One is there's even greater scarcity in the ecosystem. There's less new supply of minted Bitcoin available in the market. There's just less of it. There's less new Bitcoin coming available in the market as part of that mechanism. And of course, it drives increased competition in the mining space. The business case for any miner is basically their reward, the revenue they receive from the mining activity, less their cost. Their cost is energy. We all know about the energy impact, or we've all heard about the energy impact in the Bitcoin space. What this does, though, is incentivizes by default every miner to be as effective as possible in managing their cost base, in being able to continue mining and still be profitable. So we should probably have a whole session on that in terms of the energy impact. But at the same time, the shift and almost by design incentivization towards renewable, most effective energy sources to run the Bitcoin blockchain. But there you go. I think we've covered the halving. Expect to see this. It's expected this happens in April. I don't know if we have an exact date just yet. I've seen different numbers around this. I've seen time clocks starting the countdown. Maxime, maybe you...
Yeah, there is some countdown. It's roughly around April this year. So let's see. It's that's the current ETA at the moment. One thing that is quite interesting, I think, with halving, it's we saw the ETF approval being, let's say, not approved yet, but it's been rejected, then submitted for approval again and again. But here we have a good case of something that is immutable, right? you cannot remove the halving no matter what happens. And I think it's quite interesting with Bitcoin, this kind of duality with traditional finance and what we could call DeFi through Bitcoin. You have things that you cannot change. I mean, it could
That's
be
right.
changed with a consensus of all the miners and so on, but it's very unlikely to happen. So you have this, it's there, it will happen. ETF, whether it happens or not, I don't know, but halving, you can't change it. And that's a very
You're totally
specific
right, actually.
characteristic.
And that's the future, right? I mean, Bitcoin will become boring, utterly predictable. All of this is known. We'll know every halving until, well, not quite infinity. I think the last halving will happen in 2130, if I'm not mistaken. That's when the
Yeah,
last
21, 30, or
yeah.
40, something like that. Yeah.
But that's it. It's open source technology. Anyone can participate in the mining activities. It's open for everyone. You can download the Bitcoin blockchain. Of course, it's harder and more energy intensive to participate in this journey. But nevertheless, even as an investor or as as an interested party, if you're observing the Bitcoin market and just keep the price to one side, you know what's happening to the supply side. There's only 21 million, and there's only soon to be 3.125 BTC to be added at each block. That's it.
Yep.
So let's prepare for that. And what does this mean in terms of price? We do not offer advice at all on our channels. This is not what we're here to do.
Yeah, looks like we have a bit of lag.
What this has meant in the past is, well, as supply gets scarcer against the same levels of demand, that's simple math. That's simple demand and supply mechanics, and typically that's resulted in an upward shift. It's driven momentum, certainly, in terms of chasing the scarcer asset that's pulled up the price. But I see we have Marco back now online. Maybe Marco can share his thoughts on these demand and supply dynamics we've seen over the past halvings. Are you there, Marco?
Yeah, can you hear me?
Yeah, we can hear you loud and clear.
Okay, great. Apologies. Unfortunately, connection doesn't seem to be great, also due to weather condition at the moment. But yeah, regarding the halving and price. So this is kind of let's say economics 101. Price of something is a reflection of demand and supply. So having halving, it's called halving just because it's cut the halving. It's cut the supply side by basically factor 2. So it's half of what it was before. That makes the supply side more less. Let's say the asset is less available. So effectively, if the demand is stable, the price double. That's a simple, let's say, a very, very simple way of looking at things. Of course, everything is based on the demand. Now, the interesting fact is on the demand, because on the supply side, you have a prediction. You know how much you're going to be printing when. But the equation, the algorithm, is now it's focused mostly on the supply side. Sorry, on the demand side, which is how much demand for this asset you have. And I think this is the interesting point, because when you think about Bitcoin as an asset that has total value, it's why people buy gold, diamonds, art, is always for the scarcity of it and because it's valuable. But valuable is then another just word for scarce. So you just buy something because you know there will be so few of them and there is enough interest so that people will be even more interested just because there's not a lot. That's, for example, the way gold, right, has used as a store of value. The interesting fact about Bitcoin is that you can predict how much. It's the only asset the only one, because gold, we have no idea where the reserves are with 100% accuracy. Bitcoin is the only one that we know exactly how much Bitcoin we're going to have, and we know exactly how many we will supply at any determined time. So that's a extremely powerful thing to have, and that's, I think, once people need to realize, well, some already have, but like globally, when they say, well, but what's the value, what's the price, why the interest, is that you can predict the supply side before, like right now, actually since the beginning, and that's extremely important, because then it makes, as a financial person, it makes you do every type of calculation that you can think of, to generate metrics and to assess if it is a good moment financially if you predict a drop or a crisis in the years to come. Then what you do with an asset that is potentially reducing his supply emission, right? So it's not just the fact that is determined in the way it's supply. I think the fact that is also predictable, it's the value. And in terms of every price, what has happened in the past is that after every halving, you end up having around 500 days of bull market, which is 1.5 years of bull market. Then you have just you top on the all-time high, then is a cycle of bear market, and then you go sideways, and then you restart. Usually those periods is 4 years between each cycle. Those 3 periods are split almost evenly between the 4 years.
Thanks, Marco. If we're expecting a bubbly market, 500 or so days, that's what you quoted on average post the halving, and a halving comes in April. Sounds like we can certainly expect a bubbly couple of years. 2024 and 2025 should be full of excitement, to say the least. What we see here in the chart is also the price action it is in logarithmic scale, but I think what it also shows is the marginal decline in the uptick. So I think that's also reasonably clear to understand. Is obviously as the scale of volume increases and adoption increases, the marginal increase eventually flattens out and plateaus. I think we can't expect multiple X increases at each halving, or who knows. We'll see how history plays out, but that seems to be the trend, at least that we can see from the first cycles.
Yeah, and there is have you seen the event itself does not trigger the next day, right? A run in the market, as I was saying, is it's the beginning of the bull run. Usually it could be, you could track it on the day of the halving, because since that day you have a rising. Of course, you can push back the date. That's not, I mean, that can work as well, but it doesn't work as well as it has worked by tracking these 3 phases and starting it by the halving date. After the halving, you end up having historically those 3 phases. But of course, previous historical price give you absolutely no certainty of what's going to happen in the future, because this could have been always due to multiple factor. It's never a 1, 2, 3 variables equation. It's a multi-variable, multi-dimensional equation, the future price. So always try to put more and more info, study more, learn more, because it's never is a simple 1, 2, 3 variables equation what's going to happen in the future.
Thank you, Marco. So that's let's say the supply side story. Let's look ahead to the actually no, there's one more. Maybe Maxime, you want to cover this this let's call it more technical chart to the one we just shared?
Yeah, this illustrates what Marco mentioned in the past. What we saw when he said we could predict a little bit based on what happened in the past. We saw that we usually have the same pattern repeating again and again. So what you see here, basically it's the Fibonacci retracement. So we take the top of the previous cycle and the zero goes where we have what we usually call the capitulation. So we don't see it here because the chart represents the high of each week because it's a weekly chart. So you don't have the low, but if you put it with a real candle, you will see that each time we touch this zero with a week of a candle, and then you have two major percentage that we call the 38% and the 61%. And as you can see, the two previous cycles, Bitcoin retested the price of the 61.8% before halving. And in 2020 was a bit different because we broke down the 38 retracement, 38%, but it was during COVID. So we had this black swan event, but quickly, in a matter of a month or two, the price recovered. So the price action so far looks like a lot what happened in 2016, 2017. So we're heading towards this 61.8% price target that is around 48, 49K. And we tested this price before halving in the two previous cycles. So it looks like it's repeating kind of the same pattern. We had the low, then we moved to the 38% retracement, heading towards 61, and we stay usually in this range, so we don't go above. So let's see if it happens once again. As Marco said, it can rhymes. History doesn't really repeat itself, but we are in this range once again. And for me, it looks like a lot what happened in 2016, 2017. So again, you will see this chart. I'm far from being the only one. Like a lot of analysts are using this chart. You will see other indicators. Myself, that's, let's say, the most complex chart I'm using because I'm not a trader, more an investor. So this is my long-term perspective. I try to, always take a step back and look the big picture.
Yeah. As we said before, we're not investment advisors, just presenting data, historical data, the way it's played out vis-a-vis the halvings, as denoted by those purple vertical lines. And you can take it for face value. This is what's happened. What will happen to the right hand side in the future, we'll see. In 4 years, we can draw another purple line and see how this whole cycle plays out. So, as Marco was alluding to, the market is a game of demand and supply. We've covered the supply side now. Let's look towards the demand.
We have a bit of a connection issue. Francesco, are you still with us?
Yes, I hear some echo about it.
Okay, I don't have the echo. I have the slides. Are you back?
Okay. So, I'm back. Can you hear me?
Okay.
Yes, now I have the crypto volatility
perfect
slide.
So
that's good.
So we're on Bitcoin ETF, and before we get into where we're at, what it means, I think we've already covered in previous calls. We have 13 different institutions lining up for a Bitcoin ETF launch. Some speculators expect that approval to come out anytime, including today. Who knows? Certainly, as the risk manager in town, at least on this call, I think it's important to keep in mind that, we reached 45K in this cycle and well above that in prior cycles without TradFi, without ETF. So Bitcoin doesn't really need an ETF. Of course, an ETF will drive or expect to drive demand and therefore adoption. We can argue in a separate call the benefits, the pros and cons of going in through, let's call it a more synthetic equity type of Bitcoin as opposed to holding the real asset. But let's keep in mind that the market will remain volatile. Here we have depicted just some patterns from the past in terms of retracements and corrections, both in bull and bear markets. What we see here on the left-hand side of the screen is just how many and how deep corrections have been in the prior bull market. This was the 2017 bull market, but the same has happened pretty much in all bull markets. Whilst the price seems to parabolically make its way up, there are moments of correction, and sometimes they can be quite painful. And if you're not prepared, it can be quite counterintuitive to the traditional investor to manage those moments, let alone what happens in bear markets when those corrections are far longer and far deeper, and again, test the investors as to how and if to hold the asset. What I think is probably prudent to say is, over time, if you take a longer term horizon, all of this plays out. But if you're trying to time the market and buy low and sell high, it's going to be difficult for 99.9% of investors out there. So again, not investment advice, but do your homework as you go into this market. If demand is going to prop up and start taking us up on a significant upswing, be prepared to those moments and be prepared to manage those moments. And in particular, if you're holding the ETF, keep in mind what could happen. For instance, on a Saturday morning, 30% daily downward candle. You can't get out. You'll have to wait, or you'll have to call your bank on a weekend, or be skiing in the mountains, not being able to service you until they come back into into their office on Monday to try and process your sell order, which by then might be probably pointless. But that's my sort of view from a risk perspective. We should also cover, the positive momentum, of course, what we should expect of increased demand, and no one better than Marco can cover
that. Just maybe also like to point out the chart here is, you see, like, this is a good example. You see a chart here which is extremely positive, right? And we are pointing out all the negative, the drop downs from previous stops. This is what has already happened, but just to let you know, like, what never happened, what is impossible, it would be an impossible, the fact that you only have green candles. So generally, it's good to understand that this is a great chart, and those drops are perfectly natural. And only green candles, or as we call it, like a linear growth, does not exist in financial markets, period. No asset in the history of humanity have done that. And there is a very simple reason. Financial market is a reflection of the economy, or you can put it like this: financial market is a reflection of human activities. No human activities is linear. Linearity is something for theory and models, but it doesn't exist in human life. So it will never exist a chart on the market of any type of asset that only goes up. Only green candles. Never exist. So expect, whenever you trade, whenever you invest, drop down, because it's natural. It will happen for sure. So this usually, it's as you said, it's a mentality, right, of retail people thinking, I buy and then price will go up. Yes, long term, but in between you can have some drops. Expect them and be capable of sustain those drops.
I think what is worth re-emphasizing, not for the four of us to convince each other, but for whoever might be watching. I mean, these numbers are big, right? In traditional markets, holding on to a portfolio of equities that would drop 33% would make you very concerned, regardless of what might have happened a bit before that. I think in the crypto market, it's rather normal. It's just a question of shifting time horizons, as you rightly pointed out.
I think I can put it like this, Francesco: is the higher you go, so the higher an asset has in potential to go, the more the expectation of singularity of drop downs are higher. Or to put it like this, if you expect 100% or 200% run, you should at the same time expect 30-40% max drawdown on a single week or day. So if you want to have something that is making 5%, then of course, then max drawdown usually is between 2 and 3%. But if you want something that is going up historically to 100, 200, 300%, then you should expect some bigger drawdown on a single day.
Yeah, well put. Maybe last disclosure from a risk perspective is, if possible, avoid leverage, perpetual futures, lending of any kind. These downward corrections can really wipe out a lot of your earnings, if not all of them. So just tread carefully, and if so, only after really doing your homework. My advice would be just go in for the long ride.
And if I can add something, I was thinking also that, as we said previously, we know what we think will happen in the future, and I think everyone know what everyone is expecting at the moment from BTC, and it is something that knowing what everyone is expecting, I think the market can be manipulated pretty easily by someone that has a huge stake in crypto. So it's you need to always focus on if everyone knows what is going to happen. Maybe someone that has the possibilities can do something that manipulates the market in order to have a lower price to acquire before a bump.
Yeah, well put. I thought it'd be helpful just to contextualize what a novel ETF means for new assets, for something that wasn't there beforehand. And I think gold is a good example in my mind because, well, we often refer to Bitcoin as digital gold. What we see here is just simply what happened when gold was introduced into liquid financial markets through a spot ETF, as opposed to simply holding the physical commodity, as was the case prior to that launch date. Again, not financial advice, but simply shows what happens when suddenly you make an asset class very liquid and readily available in financial markets with big capital behind. Suddenly anyone on the planet, from large corporates, institutions to retail investors, can access such instruments, and the rest is history. Of course, as we can see from the chart, it's gone high, very high up, but it's also had its downward swings. Of course, it's a long period of time we see compressed in a small chart here, so we can't see all of the oscillations and volatility that it's had midway. But I think in aggregate, we can certainly expect demand to come in and to ramp up, if you like, volumes, and the demand side of the equation we were referring to earlier, through, against that scarce supply chart we showed earlier. Marco, what are your thoughts on
many, but that's in the interest of time, and maybe just to give a couple, because I think we'll go back to this slide in other sessions. Two things. One is why an ETF is important. Well, there is many reasons, but that's one of it, which is ETF is a compliant instrument, which means all the institutions, the big institution of the world, can buy ETF. They cannot go but currently they cannot go and buy, like have a MetaMask account and buy Bitcoin, or have an account in Binance and buy Bitcoin. So this is why the chart look like that, specific, for example, for gold, but it could be similar. I don't know, but it could be similar in case of Bitcoin. The second aspect of it is it's very interesting, is the tick. Here the tick, or the ticks, is basically on the X asset axis. You have different periods, different times. and it's 5 years, right? Everything here is 5 years. So it took gold, the mass adoption of gold in major treasury, it took, you can say, 10, 15, 7 years to actually be widespread and adopted by major institution, thanks to the ETF. So I'm thinking, let's say, be conservative, okay, and say 5 years. It's a geological era in crypto, 5 years. Everybody that I'm talking to, that I've been talking to in the past, is always about, yeah, it's like even couple of holding something for a couple of months in crypto for them looked like extremely long time. So 5 years, it's something to think about. It basically means buy and forget to a certain extent. And so it's a completely different mindset of what we said before, like we showed the drop down. All of this has emotional value, right? When you see a market going up 100% and you have that asset, and then it dropped 30%. So you see your money going up and down. And then when you look at other type of charts and you say, oh, wait, here the period of time in which should I be invested in 5 years, it's a completely different mindset. It puts you in a completely different region of space emotionally, and I think it's a good one. And as Maxime was saying, kind of is the difference between a trader and an investor. Right? Investors do their due diligence beforehand, look at hundreds of charts, and then analyze the situation, and then try to put themselves ahead of time. Traders is a different mentality. So if you are on a long-term investor, maybe you should look at more fundamentals chart and fundamental information. And why not? This is definitely one of the charts you should look at.
Very well put, Marco. I think it makes me reflect. I mean, this is really where traditional finance meets crypto. What's about to happen is this new bridge is being created between what this far has been crypto land, very volatile market, as you say, holders flipping coins in and out at lightning speed, and traditional financial institutions that may well launch these ETFs for the public in a sort of execution only buy and sell type mode, but also as mega asset managers. I'm thinking of the likes of ARK Invest, BlackRock, will start using these instruments in a longer term asset allocation perspective. The moment you start switching, say, traditional 60-40 equity fixed income portfolios to 60-39-1, for instance, the whole game change. You're starting to put huge sums of assets that crypto has frankly not yet seen. Crypto hasn't yet seen multi-billion, trillion-dollar asset managers going into these assets yet. And when they usually go in, they take a time horizon, they take a perspective over time to be able to ride the volatility and lock in the benefits in the longer term. So we'll see how this plays out, but it certainly looks optimistic for the market ecosystem. And if we've covered the ETF, maybe, I don't know, maybe any of you want to share what do you expect will be knock-on effects on the wider markets? I mean, we've spoken just about the Bitcoin side of the story. Usually Bitcoin leads the market, but then we see a lot else happening in the crypto ecosystem. Any thoughts on this before I'll pick your thoughts on stablecoins?
I thought the ETF took all the narrative, and still willing to see what will happen with the halving, because as we said before at the beginning, halving doesn't need anything. It will happen no matter what. So let's see the effect.
I just posted this morning on this very matter. I mean, at the end of the day, whether the ETF happens or not, Bitcoin and the crypto market has done extremely well regardless. So the way I look at it is warm. The more the merrier. If it comes, I think that can only do good to the wider ecosystem. It'll bring greater flows, greater awareness. Perhaps some of that traditional money might also start considering why actually hold the ETF as opposed to the underlying asset. But you typically start learning more about your asset as you hold it. And I think there'll be learning curve in the traditional financial world as a result. But again, let's wait and see what happens. Yeah. I thought I'd bring this up. In the last week, we've had a bit of price action up and down over the year, up a fair amount. It's gone back down. And as part of that liquidation, approximately 5% sell-off, actually for some coins far greater than that. USDC, a crypto stablecoin that's designed to peg the US dollar, temporarily depegged to 76 cents on the dollar. That happened 2 days ago on the 3rd of Jan. To me, this is just a reminder that we have these instruments, so-called stable coins, that are often considered or perceived to be stable coins, i.e. the value of which doesn't change and tracks its underpinning asset, be it dollar, euro, gold, as there are available in the market. I think we should just caution and remind ourselves that this isn't always the case. They try to peg, they're designed to peg the underlying asset, but can depeg under situations of distress. This happens also in global financial markets where currencies track one another and sometimes lose the peg before they hopefully regain that peg. But I think it's important to keep in mind if vast amounts of assets come into the crypto space and stablecoins are used as chosen stablecoins to keep their face value, if you like. Well, this may not happen at all times. So tread carefully, keep monitoring the markets. I would personally warrant far greater transparency and even to a degree, greater regulation in the stable space, for instance, around the auditing and the transparency around the ways stable coins are backed up by the real asset, so to speak, in order to maintain their value. So those are my extra 2 cents of sort of risk mindset in this space, but keen to get your ideas. And
we saw that recently a lot of USDT were printed, if I'm right. Usually you have a correlation between how much USDT is printed and the price action on the crypto market and Bitcoin, because it's a sign of money flowing in. Because you have those people who are swapping USDC to USDT, because it's that's where all the future markets and most of the derivatives on exchanges are traded against USDT or stable coins. So you don't usually trade derivatives against USDT or euro directly. A lot of pair trading, even on spot trading, you trade against those stable coins. That's why you have so much demand for them. And yeah, it's a real concern if it depegs, because you can expect a lot of liquidations. And also people selling on spot because they're panicking because they see those huge drawdown on their portfolio and they start selling. That's what we saw, I guess, recently. But it's a real concern. I think USDC is more audited than USDT. Not the expert here, but yeah, Tether is definitely under the scrutiny of the regulators, because yeah, it's not 100% transparent how much asset they're holding. So be careful if you're holding stable coins.
All crypto is risky, including staples.
I think I just want to echo what Maxime said. So in the crypto market, definitely the acceptance and the utility is for USDT. So Tether is the dominant asset. You cannot do really too much with USDC, right? So if you want to trade derivatives, if you want to use leverage, if you want to do even some small cap assets are traded against USDT, potentially Bitcoin and USDT, or Ethereum and USDT, but definitely USDT is the token of choice in terms of algo to trade against. So that's why people want to have it. And that dominance is holding the price quite well. At the same time, why like generally stablecoin, people should understand that when you say it's pegged to dollar, it's a virtual pegging, okay? Because the only reality that you have in your mind is in your hand when you hold stablecoin, is that what you have is the power to redeem against the treasury of that specific project. So USDT, you have the power to redeem against the treasury of Tether. Then it's a matter of do your own due diligence to understand what it is in the treasury of USDC, USDT, TUSD, whatever other stable coin you want to hold, and that's the real mechanism that you have. When people say, "Oh, it's pegged to dollar," it's a virtual thing. So don't believe that. Do your own research. Look at what's how the treasury of that specific project is is managed. What's the redeem process? How does it work? What are the fees involved? And then decide which stable coin to hold, because there is no stable coin that is one-to-one to dollar, and there is no fiat that is one-to-one to dollar. Only dollar is one-to-one to dollar. Okay, so that's a very, as Francesco was mentioning, the pegging happens every time in the traditional fiat market. Okay, so it's not a specific thing to crypto. It's just that it is a mechanism, and so you need to understand the mechanism.
Fantastic, guys. I think we can bring it to a wrap. Just under 45 minutes. We've covered quite a bit. I think quite topical matters in crypto. As we can see, crypto is risky, will remain risky for a while. But guess what? As we've said time and time again, finance is risky. Your money in your bank is risky. In fact, for the most part of it, it's not there. We've written lots about what that means. In fact, that's the name of our brand, Not Your Money, which effectively means all the money you think you've deposited at your bank is actually not really there. It's being reinvested, lent out to other investors out there. And we've seen this play out just last year yet again in traditional financial markets. That's why crypto exists. That's why Bitcoin came about and the whole ecosystem followed. So as I often say, the biggest risk in Bitcoin is not owning it. That's probably the only advice I'd be willing to share. Else than that, learn, educate yourself, spend as much time. If you don't grasp all of monetary and financial and crypto topics, that's what we're here to do. So give us a like, keep following us on any channel, YouTube, Telegram, LinkedIn, and the likes, and we'll see you next week.
Cheers, guys.
Bye-bye.
Thank you. Bye.
Bye now.